Welcome back to The Deep Dive, the show that extracts the crucial nuggets of knowledge from stacks of sources so you can get well-informed fast.
Today, we're wading into a subject that sits right at the intersection of longevity, personal finance, and unexpected risk.
We were talking about long-term care insurance,
Yes.
or LTCI.
And this is so much more than just an insurance product. It's a critical piece of asset protection.
Right.
The core assumption so many people make that Medicare or your standard health insurance will cover chronic, ongoing custodial care is completely false.
So they just won't.
They won't. This deep dive is absolutely necessary because, look, the potential cost of care can easily wipe out decades of careful retirement saving. It can fundamentally change your legacy if you get the planning wrong.
That's the perfect framing for this. Our mission today is to unpack why this insurance is so critical, how its coverage differs completely from general medical coverage, and maybe most importantly, the surprising technical and tax details that define your eligibility and, crucially, determine whether your benefits are taxable or not.
And we're looking at this globally, too. We're covering policies sold across the U.S., U.K., Canada, and Germany.
Because that global approach really shows you just how unique and complex the U.S. system has become.
So let's start with the central, often misunderstood point.
Okay.
When we talk about the need for long-term care, everyone immediately pictures, nursing homes and people over 80.
Right.
And while it is true that a huge cohort, something like 70% of U.S. individuals over 65, will require some type of extended care services.
The need is not purely an age issue.
Not at all.
Okay, let's unpack this immediately because that changes the entire risk population. Long-term care isn't just for retirement age.
No, it's fundamentally about functional ability.
Right.
The data reveals a truly shocking statistic. Approximately 40% of those currently receiving long-term care are actually between the ages of 18 and 64.
40%.
40%. That's nearly half of all recipients receiving care before traditional retirement age. So we are discussing physical and cognitive impairment, whether it's from an accident, an early onset disease, or a chronic illness, not just the inevitable decline of advanced age.
This shift in perspective really makes the product less about elder care and entirely about mitigating risk at any point in your productive life.
Precisely.
So if the need isn't solely defined by reaching a certain birthday, let's look at the drivers. Why is the discussion around long-term care becoming so urgent everywhere?
Well, the primary driver is longevity. It's as simple as that.
People are just living longer.
Exactly. Advances in modern medicine are incredible. They allow us to survive catastrophic events, a major heart attack, a severe stroke, even late-stage cancers that would have been fatal just a few decades ago.
But surviving often leaves us needing help.
Yes. Needing assistance with basic daily functions for an extended period, maybe for years.
And this longevity creates a major demographic impact, doesn't it?
It does. As the sources point out, specifically from around 2016, women tend to live longer than men. This longevity means they are disproportionately affected by the need for long-term care. But ironically, they're also frequently the ones who become the unpaid caregivers first.
To partners, parents, friends.
Right, before potentially needing care themselves. This creates a dual burden on women, both physical and financial.
That dual burden really highlights the human cost, not just the financial one.
It's huge.
I mean, when family members step in as caregivers, the emotional and professional sacrifices they make can be enormous.
And we also have to acknowledge the specific medical conditions that, while they might be rare in their early onset, they definitively necessitate this type of care down the road.
Things like early onset Alzheimer's and Parkinson's.
Devastating conditions that can strike well before age 65.
So whether the cause is age or trauma or cognitive decline, the insurance world has a single clinical standard for determining eligibility.
And it doesn't look for a traditional diagnosis of sickness.
No, it looks at function. This brings us to the core threshold for traditional LTC eligibility, the famous acronym that defines your policy's activation, ADLs.
Activities of daily living.
What are they, and how many failures trigger eligibility?
Okay, so the standard consensus for traditional tax-qualified policies is that eligibility is triggered when an individual is certified by a licensed healthcare practitioner as being unable to perform 2 of the 6 activities of daily living.
So you could be medically stable, your vitals could be fine.
Exactly. But if you cannot safely perform 2 of these basic tasks, or you require significant supervision, you qualify for benefit payments.
We need to detail those 6 ADLs, not just list them. We need to understand their real-world application because these are the words that define whether your policy pays out or not.
Absolutely. We're talking about the basic fundamental actions for self-maintenance. First is dressing.
The ability to put on and take off clothes, braces, artificial limbs.
Oh, it's not just pulling a shirt over your head. It's the fine motor skills for zippers and buttons. Second, bathing. Getting in and out of the bath or shower, washing your body. This is a common early indicator of need. It requires stability, balance.
I can see that. Number 3.
Eating. So getting food from the plate into your mouth. Now, this usually doesn't include preparing the meal, just the act of feeding yourself.
All right.
Fourth is toileting. The ability to use the toilet, manage clothing, clean up. Fifth is continence.
Maintaining control over bladder and bowel functions.
Or managing a catheter or colostomy bag. And finally, number 6 is transferring.
That's a big one.
It is. The ability to move in and out of a bed, a chair, or a wheelchair. It's one of the most mechanically demanding ADLs.
So to ground this for the listener,
Yeah.
if I have a severe stroke and I can technically feed myself and maintain continence, but I need physical help to transfer to get out of bed, and I also need help with dressing because of paralysis, I've failed 2 ADLs. That's my trigger.
That's exactly right. And if you fail 2 of those 6, the policy benefit clock typically begins, subject to the elimination period, of course.
So that's one major trigger, the functional inability. What about the second one, for cognitive decline?
The second equally important trigger is the requirement for supervision due to severe cognitive impairment.
This would be for conditions like Alzheimer's.
Or severe dementia, advanced traumatic brain injury. In these cases, the person might be perfectly capable of performing all 6 ADLs physically.
But they're a danger to themselves if left alone.
Precisely. They might wander, forget to turn off the stove, misuse medication. The inability to safely reason or navigate their environment also qualifies for benefits under most plans.
Okay, so here's the crucial point that ties back to our initial discussion of that 40% under 64 statistic.
Right.
Once a major health change occurs, a stroke, a big diagnosis, even a series of falls, LTC insurance may become completely unavailable in the U.S.
Regardless of how much money you have, this is the absolute truth that underlies the whole market.
It's not like regular health insurance.
Not at all. Unlike standard health insurance, which has to accept you regardless of pre-existing conditions, long-term care insurance is underwritten based on your current health status when you apply.
So if you wait until you are sick, or even just showing signs of decline,
You will likely be denied coverage entirely, or you'll be offered an incredibly expensive policy with severe exclusions. This is why timing the purchase is paramount.
so what is the ideal window, according to the experts? Because 61, that average purchase age, still feels like you're cutting it close.
It is. Experts are very clear. You should be shopping between ages 45 and 55.
That's the sweet spot.
It's the sweet spot where you're most likely to qualify for the best health rating, often preferred, and you can lock in your eligibility at a far lower, stable premium.
So if you wait until your 60s,
You risk encountering that one small health issue, borderline high blood pressure, a minor mobility issue, anything that could significantly increase your premium or, worse, render you uninsurable.
so the single biggest financial mistake someone makes by waiting isn't just paying a higher premium.
Yeah.
It's risking the possibility of being completely shut out of the market right when the risk is actually highest. It's about protecting your eligibility, not just your wallet.
That's the key takeaway.
So let's turn to what these policies actually cover, because the range of benefits is far broader and, frankly, more appealing than just a stay in a clinical nursing home.
Right. What are the specific services that LTC insurance can cover, which standard health plans just refuse to touch?
The list is intentionally flexible. It includes the big-ticket items like nursing homes and specialized Alzheimer's facilities, but also the services that let people maintain their dignity and independence,
So we're talking about assisted living facilities, adult daycare programs, respite care.
which is so essential for giving the primary family caregiver a break, and, critically, home care.
And that home care flexibility is really what sells this product for so many people.
How so?
Well, if you purchase home care coverage, the policy provides an extraordinary range of support. It can pay for a visiting or living caregiver, companions, certified home health aides,
Therapists, too, right?
physical, occupational, speech therapists, even private duty nurses. The goal is medically necessary services delivered in the comfort of your own home.
Potentially 24/7.
Up to your policy maximum, yes. 24 hours a day, 7 days a week.
And what about that interesting benefit, home modification. What does that practically mean?
Home modification is key to aging in place. This can cover the costs of installing a wheelchair ramp, modifying a bathroom to be ADA compliant, installing grab bars, or even specialized medical equipment like lift systems.
Things that can cost tens of thousands of dollars out of pocket.
Easily. But the LTC policy allows for reimbursement of these necessary changes that enable a safer home environment.
Okay, let's talk money. The foundational motive behind buying this product. We've established it's not about being sick in the acute sense.
No, it's about asset protection.
What exactly are we protecting our savings from?
We are protecting decades of accumulated assets and savings from the crippling costs of extended care. That's the #1 reason.
Yeah, without insurance.
Without insurance, the cost of a nursing home stay, which can easily exceed $10,000 to $15,000 a month in some areas, will quickly deplete most people's net worth.
And the cost variability is staggering.
It is. It differs drastically by region and by the type of care. For instance, in 2023, the median cost for a private room in a U.S. nursing home was well over $100,000 a year.
Wow.
A basic home health aid might be half that, but if you need round-the-clock care, those costs compound rapidly. The U.S. government has these state-by-state interactive maps.
And they're pretty eye-opening.
They are. You can see how a single year of nursing home care can just eliminate a middle-class retirement fund.
That desire to maintain financial independence is huge. But there's an equally important non-financial component, right? Avoiding reliance on family.
That's right. The secondary benefit, which is often just as important to policyholders, is maintaining personal independence.
And avoiding that strain on your kids or other family members?
Exactly. The emotional and logistical strain that comes with relying on them for physical and financial support. It buys autonomy. It buys dignity.
But we have to contrast this private insurance with the welfare safety net, Medicaid. If the costs are so high, why doesn't everyone just rely on Medicaid?
The Medicaid comparison is essential because it shows the severe gap that private LTC insurance fills.
Okay.
Medicaid is a welfare program. It's funded by the federal and state governments, and it provides long-term care services only for the poor or for those who spend down all their financial resources.
Tell us what spend down looks like in practice.
It's brutal. To qualify for Medicaid long-term care benefits, you have to exhaust your non-exempt assets, often down to a maximum of just $2,000.
So your savings, your investments?
All of it. Now, there are rules allowing a living spouse or partner to keep an additional amount, but the applicant's lifetime savings, accumulated through hard work, must essentially be wiped out before the government steps in.
So for most Americans, relying on Medicaid means intentionally impoverishing themselves.
That's what it is. It's the option of last resort after you've effectively sacrificed your entire financial legacy.
And what gaps does Medicaid leave in terms of the type of care people actually want?
Well, Medicaid generally doesn't facilitate aging in place. It heavily favors institutional settings.
So nursing homes.
Right. It generally does not cover long-term care provided in a home setting unless the state has a specific limited waiver program in place, and those often have long waiting lists.
And what about assisted living?
Medicaid typically does not pay for assisted living facilities, which are often the preferred middle ground between home care and a full nursing home.
So if you want to stay in your home or move into a private room in an assisted living facility, you have to have private funds.
Or private LTC insurance. Medicaid forces people into a very specific and often less desirable institutional setting.
Private insurance bridges that huge preference gap. It ensures you retain control
Over where and how you receive care, yes.
Now, here's where it gets really interesting for the financially savvy listener. The tax advantages. This is often the hidden benefit that makes the economics of securing a qualified policy so compelling.
There are 3 main buckets of tax benefits provided by the federal government for qualified policies. First, the premiums you pay.
Okay.
These may be eligible for an income tax deduction, much like itemized medical expenses. Now, this deduction isn't unlimited. The amount you can deduct is based entirely on the age of the covered person.
The older you are, the more you can deduct.
Right. The IRS sets these limits annually, creating a direct financial incentive to purchase while you're still relatively young and healthy.
And when the policy actually pays out, how is that benefit taxed?
This is critical. The benefits paid from a tax-qualified long-term care contract are generally excluded from your income.
They're tax-free.
They are tax-free. If you're paying for care out of your own retirement savings, every dollar of care has to be paid with after-tax money. If the policy pays out, those benefits are tax-free up to a daily limit, which is also set by the IRS.
So the government is essentially subsidizing a portion of your care costs by not taxing the benefit.
It's a massive difference in the math. You could be avoiding a 25 or 30% tax burden on those payout dollars.
That's powerful.
A powerful incentive, especially for high net worth individuals.
And finally, that third component, business deductions.
This is a major perk, a way for businesses to attract and retain key personnel tax efficiently.
How does that work?
Premiums paid by a corporation for an employee are generally 100% deductible for the business, similar to health insurance premiums, as long as the premium is not included in the employee's taxable income.
So it's a highly tax-efficient way for a business owner to provide a serious, valuable, and deductible benefit to themselves and their top executives.
A win-win.
Now we need to discuss the policy types, because the structure of the insurance market has changed fundamentally over the last decade or so.
It really has. We know that premium volatility has scared some people away, forcing the market to innovate. Traditional policies became expensive, and even existing policyholders saw these dramatic premium increases.
Sometimes over 50%.
Yes, it led to a lot of consumer anxiety.
So let's start with the classic design, the traditional policies.
Traditional policies are purely indemnity products. You pay premiums continuously, much like car insurance.
And if you never need the care?
No premiums are returned. The contract simply lapses upon death. You paid purely for that risk mitigation.
But there was an option to mitigate that use it or lose it risk.
Yes, the return of premium, or ROP rider. If you purchase this, a death benefit would be paid to your beneficiary.
And that would be equal to the premiums you paid in.
Typically, the excess of the total premiums you paid over any benefits you might have already received. It's a risk mitigation feature for those worried about wasting money, but it adds substantially to the annual premium.
Okay, so the market response to that premium volatility and the use it or lose it anxiety has been this massive shift toward the combination or hybrid policy.
This is what's driving the market now.
What are they exactly?
Combination or hybrid policies link the LTC benefit to a pre-existing financial instrument, usually life insurance or an annuity.
So that provides certainty.
It does. If you need long-term care, the policy accelerates the death benefit or annuity value to pay for care. If you die without needing care, the full death benefit or annuity value goes tax-free to your beneficiary.
So it addresses that core consumer fear. They know the money will go somewhere valuable, either to care or to their heirs.
Exactly. And the market data reflects this preference. The vast majority, 84% of new policies sold annually, are now linked benefit or hybrid policies. It's the dominant structure in new sales today.
So we have policy types based on structure, traditional versus hybrid. But there's a second, far more critical distinction based on regulation that determines your tax liability and how difficult it is to actually access the benefits.
The distinction between tax-qualified and non-tax qualified policies.
This sounds like the taxpayer's ultimate dilemma.
It is. This is the critical juncture where good counsel is paramount. Consumers instinctively want that tax deduction available from TQ policies, but paradoxically, the benefit triggers might be broader and easier to meet in the older NTQ policies.
Let's start with the tax-qualified TQ policies. These adhere strictly to federal high-pay rules, ensuring tax-free benefits.
Correct.
So what are the three strict federal rules that define TQ eligibility?
To be certified as TQ, the policy has to meet stringent criteria. First is the duration requirement.
Okay.
The person must be certified by a physician as needing care for a period expected to last at least 90 days. The ADL requirement. They must be unable to perform 2 or more ADLs without substantial assistance. The alternative is needing substantial assistance for 90 days due to severe cognitive impairment.
And third,
a plan of care. A licensed healthcare practitioner must provide a written plan of care, certifying that the services being received are medically necessary.
let's drill into substantial assistance. This isn't just someone standing nearby, is it?
No, the IRS standard for substantial assistance is very specific. It means 2 distinct things.
Which are?
Hands-on assistance, where the physical presence of another person is required to help you perform the activity, or standby assistance.
Standby assistance.
The presence of another person within arm's reach is necessary to prevent injury while you perform the activity. For example, supervising someone who is unsteady while bathing, and that need for supervision must be constant, not occasional.
Okay, so if I can mostly dress myself, but I sometimes lose my balance and need someone ready to catch me, I meet the standby assistance definition for dressing.
That's right.
But I must fail 2 of the 6 ADLs at this level of need, or suffer severe cognitive impairment to activate a TQ policy.
Correct. The threshold is high, but the reward is guaranteed. The benefits you receive are non-taxable under current federal law.
So now we move to the non-tax qualified or NTQ policies. These were common before the IPA guidelines established the TQ standard. Why would anyone risk buying a policy whose tax status is ambiguous?
The appeal is the benefit trigger mechanism.
It's easier.
Much easier. NTQ policies often include what's called a medical necessity trigger. This is much broader and more flexible than the TQ standard. A doctor can simply state that the patient needs care for any medical reason and the policy will pay.
It's based on professional medical opinion, not a strict 2 ADL minimum.
Exactly. And their ADL requirements are typically much more lenient, too.
How so?
Well, NTQ policies often only require the inability to perform 1 or more ADL compared to the TQ requirement of 2 or more. And importantly, NTQ policies often include walking or mobility as an ADL.
Which is specifically excluded from the core 6 ADLs used by the TQ standard.
Right.
This sounds fantastic. Easier to qualify, broader triggers, greater flexibility. So what is the massive risk here? Why is it a dilemma?
The risk lies entirely with the taxman, the Treasury Department.
I see.
They have not clarified the tax status of benefits received under a non-tax qualified plan. This means the taxability of those benefits is completely open to interpretation by the IRS.
What does that financial risk look like in hard numbers? I mean, how bad could it be?
It could be devastating. Let's say you receive a large payout, maybe $500,000 over 5 years of care.
Okay.
If the IRS decides that those benefits are taxable income, treating them like an annuity payout, for example, you could suddenly face a massive surprise tax bill.
You could lose 20 or 30% of your benefit just to taxes.
Or more. It fundamentally changes the math of your coverage and could force you to spend down your assets anyway just to cover the tax liability.
So you think you've protected your assets, only to find the benefit. Money is itself subject to a substantial tax claim.
It forces the consumer into an agonizing choice.
Choose the TQ policy with its stricter, harder-to-meet triggers to guarantee tax-free benefits, or
choose the NTQ policy with easier, broader triggers but risk that significant, unquantified tax exposure.
And most people don't even know which one they have.
That's the shocking part. A survey found that 65% of purchasers did not even know whether the policy they bought was tax qualified or not.
If you don't know the regulatory status, you can't possibly weigh the risks.
It just underscores the need for informed advice.
Let's move past the tax trap and look at the actual policy mechanics once the contract is signed. What kind of long-term stability can a policyholder expect?
This is where the product is very strong in terms of consumer protection.
Okay.
Once you purchase a policy, the language and core benefits cannot be changed by the insurance company. They can't retroactively alter the ADL definitions or reduce your benefit amount.
That's a huge safeguard.
It is. Furthermore, the policy is usually guaranteed renewable for life. It can never be canceled by the insurance company because your health gets worse or you get a new diagnosis.
The only way they can cancel is if you don't pay.
For non-payment of premiums, that's it. It gives the policyholder immense peace of mind.
So, if the language is stable, how are the rates determined? What are the 6 core factors and why are they so sensitive to age?
The rates are determined by 6 interacting factors. First and most important, the person's age at purchase.
The younger you are, the lower your rate.
And it's locked in for life. Second, the daily or monthly benefit chosen, how much the policy will pay out.
Higher benefit, higher premium.
Right. Third, the benefit duration, how long the benefits will pay. 2 years, 5 years, lifetime. Lifetime is obviously the most expensive.
What's number 4?
The elimination period. This is your deductible. A shorter elimination period means a higher premium. 5th is inflation protection, which is crucial. And 6th is your health rating from underwriting preferred, standard, or substandard.
That age factor just reinforces the 45 to 55 recommendation, doesn't it?
It does. The fact that the average purchasing age dropped from 68 in 1990 down to 61 in 2005 shows buyers are responding to these market signals.
Trying to lock in better rates earlier.
And beyond individual rates, many companies offer incentives for couples. Most will offer couples and multi-life discounts, often 10 to 30%.
And what's fascinating is the modern interpretation of couples.
It's very broad. Some companies include not only married spouses, but also 2 people who meet criteria for living together in a committed relationship and sharing basic living expenses. It's the market adapting.
Let's tackle that 4th factor in detail. The elimination period. We know it's the deductible, but how does it actually function?
The elimination period is the waiting period,
Yeah.
typically 30, 60, 90, or 120 days, during which you have to pay for care out of your own pocket before the insurance benefits begin.
It's a cost-sharing mechanism.
Exactly. It reduces the insurer's initial exposure.
But what's the critical detail most people miss about satisfying this period? It's not just calendar time, is it?
No, and that's the insider detail. While some policies use simple calendar days, many require you to provide proof of 30 to 120 service days of paid care before any benefits will be paid.
So if you only receive care 3 days a week,
A 90-day elimination period could take months to satisfy. You have to be paying out of pocket for the required number of service days before the insurance officially kicks in.
that is a major financial distinction. It means you must have a substantial emergency fund reserved specifically to cover those initial repair costs.
Absolutely. However, there is a flexibility option, which is particularly popular for people who want to age in place.
What's that?
The option may be available to select 0 elimination days for home care services, as long as those services are delivered in accordance with a plan of care.
That zero elimination option for home care must drastically increase the likelihood of using the benefits.
It does. It removes the barrier to entry. This is precisely why someone purchasing coverage at age 65 has a 50% likelihood of using their policy benefits, especially if they select that option. It makes activation much easier.
Speaking of activation, we need to connect private insurance back to the welfare system through something called partnership plans.
Yes, partnership plans are a direct outcome of the Deficit Reduction Act of 2005, designed to solve that spend-down problem.
They bridge the gap between private insurance and Medicaid.
For middle-class families, they're essential.
So how does this mechanism work to protect assets from that Medicaid spend down?
It provides dollar-for-dollar lifetime asset protection. For every dollar of private LTC insurance benefits you use, that same dollar amount is disregarded when calculating your eligibility for Medicaid later on.
Can you give us an example of how that saves someone from impoverishment?
Sure. Let's say you bought a partnership policy with a total benefit pool of $300,000.
Yeah.
You use that entire amount for care over several years. Even if you needed Medicaid later, that $300,000 is protected. It will not need to be spent down before Medicaid kicks in.
So you can keep $300,000 in assets that you would otherwise have had to exhaust.
Exactly. As of 2014, 41 states had active partnership programs, making this a widely available, powerful incentive to buy private coverage.
That's the government explicitly rewarding proactive planning. So to wrap up the U.S. snapshot, let's look at the sheer scale of the market.
It's a vast market. Currently, about 7 million individuals have some form of long-term care coverage.
And the claims being paid demonstrate that this is a system in action, not just theory.
Definitely. $11 billion in claims were paid in 2019 to some 310,000 policyholders. The benefits are being used heavily, which validates the necessity of the product.
Moving beyond the U.S., let's look at how other developed nations approach this specific universal need. It provides crucial context.
Especially when you compare mandatory versus voluntary systems and how they approach consumer risk. It's fascinating to see how other major economies structure their approach.
The U.S. relies heavily on a complex private market, contrasted with a welfare floor.
Right, whereas Canada and Germany offer different models.
Starting with Canada, the policies are structurally similar to U.S. traditional models, but what are the common riders or consumer protections available there?
Canadian policies frequently emphasize certain risk mitigation riders. The first is the ROPD return of premium on death.
Similar to the U.S. ROP rider.
It is. If you pass away without using the policy benefits, a portion or all of the premiums are returned to your estate. It provides that certainty that the money won't be wasted.
And the second essential protection focuses on the rising cost of care.
That's the protection from inflation rider. In Canada, this is extremely common and highly recommended.
Because long-term care costs rise faster than general inflation.
Much faster. So this rider ensures that the policy benefit grows at a set rate, often 3 or 5% compounded annually over time.
So a policy you buy at age 50 with a $200 daily benefit.
By the time you need it at age 80, might be paying $450 a day. It's vital for keeping up with the true cost of care decades later.
Let's pivot to Germany, because the German system is a completely different approach. They mandate a baseline of coverage.
Germany is a fascinating case study in integrated social welfare. They mandate basic care insurance for all citizens.
It's one of 5 pillars of mandatory social insurance there.
Along with health, accident, unemployment, and pension insurance, this ensures everyone has a fundamental basic floor of coverage.
And it avoids that moral hazard of a large population spending down their assets to reach the welfare net.
Exactly.
And how is the cost structured for that mandatory coverage?
It's a shared financial responsibility model. The costs for the mandatory care insurance are evenly split between employers and employees.
So it spreads the burden across the working economy.
Right, rather than placing it solely on the individual or the state.
But even with that mandatory coverage, there's still a voluntary private market to supplement the basic state-mandated care.
That's correct. The mandatory coverage provides a floor, but it often does not cover the full cost of high-quality facilities or private rooms. So the private market exists to provide supplementary options,
And there are 3 distinct types of voluntary private insurance available in Germany.
each addressing a different risk preference.
Let's define those 3. Type 1 is the most expensive, right?
Yes, type 1 is often called the life insurance hybrid or fixed pension model. It's the most expensive because it pays the insured a fixed monthly pension amount predetermined when the contract is made, when they need care.
And it pays this fixed amount regardless of what the actual care costs are.
Right, based purely on the chosen care level. This offers certainty, but if care costs rise faster than expected, you may still have a gap.
What about the second form, the percentage payer?
The percentage payer is highly sophisticated for managing inflation risk. This insurance pays a certain percentage of the actual cost of care, but only after the mandatory state insurance has paid its share.
That structure seems inherently protective against the unexpected rise in medical service costs.
It is its core advantage. Because it's tied to the actual cost of services, the insurance pays more money when the care costs more. It effectively lowers the insured person's risk of being ruined by raised prices in the care market.
It ensures that coverage maintains its relative value.
Exactly.
And the third and most common private policy type.
That is the per diem model. This is the simplest to understand and most common choice for supplementing the German mandatory system.
How does it work?
It pays a certain fixed amount of money for each day that the insured is being taken care of. It's simpler than the percentage model, but requires the policyholder to adjust the fixed benefit over time to keep up with inflation.
Or risk having the coverage amount become inadequate. So even in a country with a socialized floor, the complexity of private planning still exists, driven by the desire for quality, control, and inflation protection.
That's the bottom line.
This has been a critical exploration into what is arguably one of the most essential yet poorly understood financial planning tools available. Let's synthesize the major themes for our listener.
The key takeaway is that LTC is fundamentally a financial tool. It's driven by increasing human longevity, and its sole purpose is asset protection.
And its benefits are defined not by traditional sickness, but by functional loss.
The specific clinical language of the activities of daily living. And for any U.S. purchaser, navigating the complex distinction between tax-qualified and non-tax-qualified policies is the highest hurdle you have to clear.
To ensure your financial protection is secure and tax-free. And the central action point, whether you're in the U.S. or navigating a supplementary market abroad, is timing.
It's everything.
The importance of shopping early, ideally between ages 45 and 55, to secure the lowest rates and lock in the policy structure before a major health change occurs, is paramount.
Because once your health status shifts, the policy you need may become financially prohibitive or completely unavailable.
Exactly.
Before we wrap up, I want to leave you with one final provocative thought that builds on the U.S. market structure and consumer protection.
Okay.
We spent a lot of time noting that policies purchased from state-regulated insurance companies are guaranteed renewable and the language can't be changed.
But there's a loophole for large groups, isn't there?
There is a serious risk for those who obtain coverage through large retirement systems or major employers like CalPERS.
How so?
Because these organizations often create their own group-like LTC plans, they are often not regulated by the state insurance departments. They operate outside that critical consumer protection safety net.
What's the consequence of that lack of oversight?
The consequence is that these non-regulated groups can increase rates and, in some cases, make changes to the actual policy structure without the rigorous state scrutiny and approval that traditional carriers must submit to.
So we've seen massive, unexpected rate hikes in these non-regulated plans.
Yes. Your policy might be guaranteed renewable, but that guarantee does not necessarily extend to guaranteed rate stability.
That raises a critical question about oversight. If you're offered coverage through a large employer or a retirement organization, you need to verify precisely which regulatory body is scrutinizing the policy.
And the rate increases before you commit, because your guarantee of stability might not be as solid as you assume.
Protection isn't just about the policy language, it's about the regulatory framework surrounding it.
Food for thought indeed.
That's all the time we have for this deep dive. We hope this knowledge empowers you to plan ahead and secure your future.